Hey everyone, so this is going to be a DCF for NVIDIA, which I've done before, but I've gotten a lot of comments on those previous DCF videos of, well, NVIDIA is so much higher now, like you are wrong, and etc. etc. And I felt like I needed to do this DCF because, first of all, whenever I create a DCF, it's based off of street estimates, so based off of what analysts believe at the time of the when I stream. And so I can only go with the information I have. But anyway, given that NVIDIA has just released earnings yesterday and it just blew past them and we have a lot of new numbers to work with, I thought it would be good to use those numbers and basically create a new DCF to see what NVIDIA's stock can reasonably kind of trade at based on the numbers that we have. So looking at our agenda, we're going to talk about NVIDIA situation overview. Then I want to go into trading comps, which I don't think I did last time for NVIDIA because it's kind of a new thing. So I think that'll be interesting for you guys. Talk about Wall Street Prep, our sponsor for today's video. Then go into the DCF, WACC, mid-year convention, discuss the price depending on where we get to. And then, so yeah, that's pretty much it. So let's first look at NVIDIA's stock. So the company has blown past earnings, and now I read is the combined market cap of Amazon and Tesla, or even more than that, because Tesla has been on a huge downward trend. Over the past 6 months, you can see that the stock has pretty much doubled. Over the past few days, has gone up by about 10%. It's gone up 11% since yesterday, which is when earnings came out. So why did the stock jump? Excuse me. And then what are some other interesting things? Let me drink some water, actually. Okay, so quarterly revenue of $26 billion, up 18%. That's crazy that the company's earning that much money or that much revenue. 10-for-1 stock split effective June 7th, 2024. I think that's also very, very notable because that just means starting in basically 2 weeks from now, when you watch this video, if you're watching it June 7th onwards, you're going to see that the stock is probably trading around like, I don't know, 90 to 100 to 120-ish, 90 to 120-ish dollars probably, instead of the 1,000 that it is right now. And usually it's just more like a psychological thing that companies like to do in order to get more people to be able to feel comfortable purchasing the stock when it's quote unquote looks cheaper. And then quarterly cash dividend raised 150% to 1 cent per share on a post-split basis. So basically, it's I guess previously right on a pre-split basis it would be 10%, 10 cents. So previously it was probably like 0.0 something cents per share. So these are like kind of the interesting things. I also wanted to show you guys exactly like how much it beat earnings by. So hopefully you guys can see this. This might be a little small, but I went on to FactSet. So adjusted per share earnings surged $6.12 versus $1.09 a year earlier. That's like a crazy increase. That topped consensus on Cap IQ of $5.58. So it's beat by around 60 cents or so, which is also a very big beat. Then revenue more than tripled to $26.04 billion, higher than the street's call of $24.59 billion. So just insane growth for this company. And it's like almost unbelievable, really, but it's just so crazy. So let's go into the bull case and bear case. So the bull case is AI and data center expansion positions the company well for continued growth. I think that's probably the biggest driver for the company right now, especially with all the buzz about AI, and NVIDIA is coming up with very what's the word? Specialized chips for AI and really leading that charge. Dominant position in the gaming GPU market ensures a steady revenue stream, and gaming is not as hot as, AI, of course, but definitely still very, very strong. And then advancements in autonomous driving and edge computing present growth opportunities. And so basically all of the hottest tech trends, really, AI is kind of like powering all of that. And so that's really the big bull case. Bear case, supply chain issues could affect ability to meet demand. We saw a lot of this during COVID, and it's always a potential issue. Second, intense competition from companies like AMD could impact market share and profitability. Right now, NVIDIA is a clear leader, but you never know. Competition is extremely fierce. There's also a lot of talk about how tech companies are bringing chip making in-house, and so that's a potential issue. And then also high valuation concerns. So, everyone knows that NVIDIA is quote unquote kind of like expensive right now. And we're going to go into trading comps to really kind of discuss that. But what this really just means is that as an investor, if you are buying into NVIDIA, you're buying into kind of perfection. You're expecting the company to basically blow past street expectations every quarter. And if anything goes wrong, then the stock can really, really drop off quickly. Like I think Tesla is a great example. When the stock is high and, the company is doing well, then everyone is just, a bull and everyone looks like a genius. But then right now, if you look at, I think Tesla is probably kind of like a good stock to look at as an example. And Tesla also did, like a stock split after the stock ran like super high. So if you look at the stock, let's go 5 years, you can see that huge upward. Everyone was going crazy about Tesla. And then now it's kind of on a downward trend, but of course, still a great company and there's a lot of room for a comeback. But I'm just saying that you're priced for perfection when you're trading at the multiples like companies like Tesla and NVIDIA. So let's actually go into those multiples. So this is a comps table of that I built out for NVIDIA. And normally I don't actually have this available to download, but I will actually be posting about this on LinkedIn, where probably within like 1 or 2 days, I'll have a post where you can download this. So, or I'll send it to your email. So look on my LinkedIn for that. You can just look up Ben Chan. But so basically what you see here, if you've never seen something like this before, is some kind of trading information and like financial information for the company. And let's start off with things like market cap. So I've also organized this into kind of chip makers here, and then also kind of like large tech companies. So if you look here, you can see that the market cap of NVIDIA extremely high. Only if you look at the largest tech companies in the world, only less than Microsoft and Apple, and right around where Google is. And this hasn't been updated for today's trading actually, which would actually make it larger than or about the same size of Amazon plus Tesla. So as you can see right here, NVIDIA's price is at $949. Let me actually update this for today's date so we get, fresh numbers. But this is going to take a little bit of time. It kind of lags when I have to update these numbers. So let's just wait a little bit. As you can see here, it's going to take probably 20 seconds or so. But while I do that, happy to answer some questions in the chat. So do you own NVIDIA stock? So I don't purchase individual stocks, at least right now. I've been so busy with school that I haven't been doing that. But, I have exposure just through ETFs and stuff like that. A lot of these DCF videos is really for you guys to play around with the model. It's not necessarily for me to, right? At least I don't feel like I want to be telling people like, hey, buy this stock or whatever, not financial. Oh, I forgot to actually go through the notes and reminders. So This model will be available for free to download after the stream ends if you look at the description. And this is also a high-level street-based DCF, so not financial advice. Something more, if you want to, you can use the information by downloading this Excel to, guide your investments if you'd like. But, not financial advice. Next, financial statement Excel shortcut DCF tutorials are in the description for this video. And I'm also working on a how to get into banking course, which you can check out. I'll leave a link to as well. But let's go back into trading comps. So you can see here now it's been updated to $1,000.51 about where NVIDIA is trading right now. And market hasn't closed yet, but probably will close around $1,050. And if you look at the market cap for Amazon and Tesla, that is about 2.48 billion, which is roughly around where NVIDIA is. So I guess, okay, not larger than the two combined, but pretty close, and it may eventually get there. You can see NVIDIA stock is trading at an all-time high. So are a lot of semiconductor companies, actually, except for Intel and AMD. And then compared to the top tech companies, everyone's trading near an all-time high except for Tesla. Now here's where things get pretty crazy, which is just, revenue growth, 102% compared to 2024. Street's estimating 33% next year, but honestly, I wouldn't be surprised if NVIDIA blows past these numbers. This is a lot higher than all companies except for, pretty much all companies. All semiconductors. NVIDIA's growing expected to grow at a much higher rate. And then gross margin, pretty much the company is higher than all companies, all semiconductor companies except Broadcom, higher than all tech companies. Tesla super low. And then EBIT margin wise, the strongest, same with EBITDA margin, those are closely correlated. Strongest margins and profit margins compared to all semiconductor companies and all tech companies. So pretty much you can say that NVIDIA has the highest growth and the best margins compared to all of the top companies in the world. So that's why the stock is trading at like crazy prices. And let's now look at trading multiples, which is really the focus of trading comps. And this is where you're basically figuring out how expensive is this company compared to other companies. So basically we have different categories here, but we have revenue. We're not going to actually look at gross profit. This is pretty useless for, actually revenue multiples are also kind of useless for companies of this size. But basically what this is saying is that you're paying $20.80 for every dollar that in revenue that NVIDIA earns, which is actually a lot for a company this size. And then for EV over EBITDA, you're paying $32.20 for every dollar in EBITDA that the company earns, and then $40.10 for every dollar in earnings or net income that the company earns. So as you can see in the red here, it's nicely color coded so you can kind of like intuitively understand what's going on. Let's not really focus on revenue multiples because these are when a company gets more mature, you care a lot more about profitability. So when you look at these figures, you can see that the company, even though it has extremely high margins, is trading a lot more expensive than a lot of pretty much every single company on this list except for Tesla. And I think that actually speaks to how there's still potentially room for Tesla to fall, because it just means that Tesla's more expensive than NVIDIA, which has way higher growth and way higher profit margins. Now, not a lot of people are going to call me a Tesla hater, but I'm just honestly just trying to show you what the numbers are saying. I'm also, when I mentioned earlier about how NVIDIA is kind of priced for perfection, this is also kind of indicative of that, basically if NVIDIA does not keep up this like stellar growth and margins that it has, then it can easily fall because it's priced for perfection. But with that said, you know, the thing about multiples is that companies grow into their multiples fairly quickly. And so what that means is that even though these multiples may look high right now, if the company continues to have like a very strong revenue growth or if it continues to have very strong revenue growth and remains profitability, then then sorry, I think I wanted to fix something here, but I guess it's okay. Then the company can easily okay, it was wrong. It can easily have like what looks like more and more like reasonable multiples as time goes on. So for example, like EV over EBITDA this year is around 32.2x, but then growing based on the growth next year is going down to 24.5x. But if EBITDA surprises and is even higher than what analysts believe, then this could easily go down to something like, you know, 20x, 15x or something like that. Okay, so the last thing to kind of look at here, and I'm going to not look at the NTM over EBITDA or NTM or premium discount to historical multiples for next 12 months for revenue. We don't want, pretty useless. So basically what this is looking at is based on historical multiples, is company trading at a premium or a discount? Another good like kind of just sense check. And basically what you can see here is that NVIDIA is trading a little bit higher than, or it's trading a little bit at a discount compared to the previous years. And actually this color coding is also wrong. Sorry about that. So negative high is bad. So, okay, so what this is basically saying is NVIDIA is trading at a 10% discount to its EBITDA multiples from a year ago. And that's actually very surprising because NVIDIA is, you know, trading even higher than it has in all of its history. So I guess that what that really just speaks to is the fact that NVIDIA was even more expensive on a multiples basis than before. But yeah, I guess like it's not trading at the most expensive it's ever been trading at, which yeah, again, is surprising, but a good sign if you're an NVIDIA stock bull, if you're an NVIDIA bull. So I see a question here of like, how is market cap higher than enterprise value? I think maybe you're asking about the multiples here and why they're higher. And you actually always expect, as you go down the income statement, for your multiples to be higher when you are looking at the related financial metrics. So revenue multiples should be lower than your EBITDA multiples, and your EBITDA multiple should be lower than your PE multiple. And that's just because your revenue is a higher number than your EBITDA, because you go from revenue, subtract out your costs, your operating expenses, etc. Then you get to your EBITDA. And then you subtract out your interest, taxes, depreciation, amortization to get to your net income. And price over earnings is just your market cap over your net income, essentially, or price per share over earnings per share. Same thing. So when you have a smaller number on the denominator, while your numerator is fairly consistent, like enterprise value and market cap, I'll scroll to the left here, are different but fairly the same. So market cap, enterprise value. So that's why your multiples, as you go down the income statement, should get higher and higher. All right, so that was comps. Basically, TLDR, NVIDIA, really great revenue growth, really great margins, trading a little bit expensive, actually quite expensive, but not as expensive as it has over the past 1 to 5 years, which is surprising. That's the TLDR. I also wanted to kind of go over a bit of like the previous NVIDIA model that I had built, right? This was expecting 2023 revenue of 51.8 billion and then 78 billion for 2024. I pulled together some new numbers, but I feel like they may already be outdated actually of estimates. I want to make sure I'm using the most up-to-date numbers. So, but you can see here like 2023, wait, why is that so high? Okay, yeah, that's right. 51.8 billion, 78 billion. Now these estimates are like 58 billion, 108 billion. So that's why I had, a lower stock price estimate based on the model because the numbers have just changed so much. And I downloaded those numbers yesterday, by the way, at night. And it's 108 billion. Okay, so everything looks pretty updated. I guess all the Wall Street analysts updated all their numbers like fairly quickly. But I wouldn't be surprised if even tomorrow or like a day from now, these estimates are already stale. And let me actually take a look to double check and see before I start modeling anything when all of these sales estimates were updated. Okay, and as this loads, see if there are any questions in the chat. Okay, don't see any, but if you guys ever have questions, feel free to ask away. All right, so 2020, all right, so NVIDIA reports on a end of January basis instead of a calendar year like December 31st basis, which is kind of annoying, but oh well. Okay, so it looks like a lot of these companies, these are just a list of different Wall Street analysts, and the vast majority of them have updated, but about like 10 or so have not. So you can see these, analysts move very fast, and today is May 23rd, and the vast majority of analysts have already kind of updated their figures. But I would imagine that, the estimates that we're going to use today, they're going to go even higher once all these estimates are actually included and raise up the kind of average and median, which is what we use. So what that means is for my model that I'm building today, I'm going to actually be a little bit more optimistic than the numbers we have because I think, or because of the reason I just said. Also interesting to note, a lot of these companies increase their target prices. So everyone is bullish on NVIDIA. Basically, no one thinks that it's going to go down. But, analyst estimates are wrong all the time. Okay, so let's go into the agenda, Wall Street Prep. So today's sponsor for the video, wanted to let you guys know. I also saw a question about, are there any trading courses for beginners? This isn't necessarily for beginners, but if you want to level up your learning quite a bit, then there's this hedge fund and buy-side investing certificate program that's offered by Wharton and Wall Street Prep. Wharton is at where I actually just finished getting my MBA, graduated this past Sunday. And this 8-week program is kind of like an online certificate program where you'll be learning from, as you see down here, Wharton professors, and then also Wall Street Prep program directors. And you can also listen to keynote speakers from a lot of great investors. I actually met Howard Marks. He came to speak at Wharton, and he has a very, very good podcast where he reads a lot of his memos, and his memos are very famous. I would highly recommend looking it up. Just look up like Howard Marks, the memo, I think it might be called. But if you listen to that, it'll really, really help a lot with your investing mindset. And basically throughout this course, what you get are you learn about investment fundamentals, then buy-side modeling, how to develop a thesis, which is what you really are focused on when you're working at a hedge fund, and then advanced concepts, bringing it all together. So basically everything you need to know for the foundations of what it's like to work on the buy side at a fund. And if we keep going down, I think one of the cool things is that you kind of join this like network where you're able to meet people across different certificate programs. You join like a Wall Street Prep and Wharton only group on LinkedIn. You can add a certificate to your LinkedIn, cross-program networking events. So there's a lot of other of these programs, like a private equity one that Wall Street Prep and Wharton has. And so you can kind of like basically network with people from all the different programs. So check out this program if you're interested. You can use my code RareLiquid to get up to $500 off. If you sign up early enough, you get an early bird discount of $200, and then by using RareLiquid, you get $300 off. So that's Wall Street Prep. And next, let's see, street-based DCF is what we're going to go into next. So basically just time to build the model. All right, so I see a question here. What are my plans after MBA? I'm going to be working on RareLiquid full time. So yeah, that's what I'm going to be doing. Have a lot to work on actually. Okay, so this is NVIDIA DCF. Let me zoom in for all of you guys. All right. So I'm going to, in the interest of time, and you guys actually, like if you go to my old NVIDIA model, probably can do the same thing as what I'm doing now, which is I'm going to basically, actually maybe I'll bring it down here so you guys can, I have two screens, one up here and one down here. But to save time, I'm going to kind of copy a lot of the formatting since we're going to be doing like a lot of very similar stuff. So let's just copy a lot of this. Actually, I may use something from a different model actually to, yeah, for this, I'll copy these 3 rows. Okay. And then actually what I want to do is potentially we may use one of my other models instead. I'm going to also close out some, maybe I'll use FactSet. I'm going to need FactSet later. But for now, it's kind of lagging my computer. So I'm going to get out of FactSet. And then I'm also going to get, will I need these comps? Okay, if I need these comps later, actually we are going to need to look at it later. So I'll keep that. Maybe I'll exit out of all my tabs here. I don't even know if this makes a difference. Seems to not be making any difference really. I think it's just the stream that's making my computer lag a bit. Okay. But hopefully, I think from your guys' end, you guys won't see much lag. All right, I'm actually going to go into my old Reddit DCF, which you can also, if you actually go to my YouTube channel and if you want to look at like previous models and stuff, it's really easy to go to my playlists on my channel. And then if you go to live, then you'll see all my previous DCF models. This is taking forever. All right, just waiting for this to load. As this does, maybe I'll just start taking from this one actually. Okay, so we're gonna need our assumptions. Then we're gonna pull from income statement. I'll just copy paste this stuff. All this information is stale, so just gonna delete everything. I think last time I had this, I like had to calendarize things or something, but this time I pulled everything as of the end of December 31st instead of January. So things should be a little bit easier. Okay, so Reddit. Yeah, I have like a little bit more detailed type of assumption format. So I'm going to copy from Reddit. Not that much more detailed. I still actually want to make this look nicer. Ooh, what is this? Oh, okay. I think there may be some formulas or something here. Okay, they're all pasted as values, so that's fine. Okay. So I'm going to delete all the assumptions that we have in here since everything is going to change. Okay, and so let's see. First thing, we just want to basically take the numbers that we I've gathered already, like the historical figures, and I pulled them starting 2014. So let's just link to 2014, go all the way to 2023, which is no longer E just means expected. Let me actually make this A. So A will be for actual, and then E will be for expected. And then estimates, this is where we're going to pull from street estimates that, again, as we discussed already, are probably a little bit too conservative right now, even though they're kind of crazy high. Or it just means, what I mean is just that NVIDIA is just expected to grow so much. 2028, we're probably not going to use anyway. So let's delete that. Okay, so those are the street estimates. Let's check how much the company has been growing by. And as you can see, it's just crazy. Like basically 10 years ago, NVIDIA was at 4.6 billion. And now the company is expected to do $108 billion in revenue. It's like a 20x, more than 20x growth in revenue. And it's also just crazy because of the scale at which it's growing. And also, if you look at all this, like the company was, growing pretty strongly, but to grow from 27 billion to 55 billion and then to 108 billion, like it's just insane. So that's in that is revenue. And now let's look at operating income. I think the interesting thing here is that the company has always been pretty profitable. But now, of course, it's just going like next level. Okay, also, it looks like there's a discrepancy between what is like reported, probably just like GAAP reporting. Like if you look here, 2023 is a lot higher than the EBITDA here of 30, or lower than the 34 billion here. GAAP is 30.5 billion, while it's 28 billion here. There's some kind of discrepancy, but I'm just going to actually go with what the estimates that we have here, or with the figures that we have here. Seems like, let's see, operating income 69 billion, non-GAAP. Okay. I'm just going to go with this operating income number. So what this means is I'm going to add, like, we typically want to be seeing kind of like a trend, and that's how we kind of want to look at our figures. But okay, so I think what I'll do, why is these red? All right. Okay, so these, these figures, okay, you know what I'll do is actually I'll just go download more. I want things to be consistent, so I will just actually download EBIT numbers that are also non-GAAP, so that we're not having like this weird discrepancy. But FactSet is going to take forever to load, so while it does, let's work on the cash flow items. So historically, let's see, we go to our cash flow statement, 2014, depreciation, depletion, and amortization. I've not seen that before. Not sure what depletion is, but I don't think it's that important to figure out. So as I remember from last time, capex, depreciation, amortization, all like kind of cancel each other out for NVIDIA, so it shouldn't be that big of a deal. Okay. And let's get out of Reddit. Don't need this anymore. And then if I go to my old old NVIDIA model, I hard coded this, and I have why would I do that? I'm not sure why I did that. The reason might be because like I had to actually I have no idea. I don't know why I would do that instead of linking it. But either way, this time not doing that. Almost should never do that actually. I think I wanted to save time. And then if we go to exit just disappeared. Okay, I'm gonna reload it, but while I wait for that, let's finish out our cash flow items. So pretty steady, just a few percent. I mean, honestly, NVIDIA is quite, just from a numbers perspective, quite an amazing company. CapEx, I like keeping all my numbers positive. So while this is a cash outflow, I'm going to show it here as a positive figure, and we'll subtract it out later. Yeah, so you can see CapEx is pretty much, it's like nothing for a company that size. Okay. And then what do we need next? Or what do we have here? We do have depreciation, amortization. No CapEx, but we can just estimate that easily. Changes in net working capital should be in our cash flow statement. So this is also cash outflow. Make it positive. Okay, so we have our percent, our change in net working capital is a percentage of sales, and then we can also try it as percent change in sales. Oops. Lagging. Okay, so we have our cash flow items. What I wanted to do while FactSet, what I wanted to do with FactSet is get the estimates. Okay, FactSet. Oh, here it is. So go into company, and this is going to load slowly. I see some interesting comments in the chat. So it's possible. Making DCF automated could possibly be my Python Power. Yeah, that's cool. Yeah. Okay. Yeah. So, I mean, obviously, I think making a DCF can be automated in terms of structure. I think it's just always important if you're learning, and that's why you're, on in this stream to actually still understand the fundamentals. So that later on, when you need to make very, very, very specific changes in an Excel, that you know exactly how to do it and what everything means, right? So maybe investment banking analysts will eventually be able to be replaced by AI. But what I always like to think about is actually, if you think just like, I forget how many years, but let's say like 40, 50 years ago, my MDs would talk about how you needed to go all the way to the public library and then photocopy financial statements, bring it to the office, and then maybe it was more than 40, 50 years ago, but that's how they used to do it. And now with things like FactSet, Bloomberg, you instantly can get all your financial figures, yet analysts are still working the same number of hours, right? In terms of like, they're just still working extremely long hours. And so that's just because the more tools you get, just the more work you end up having to do. Which doesn't really bode well for investment banking analysts, but I feel like even with like really good AI tools and etc., it'll be a while until analysts can actually be replaced enough to the point where they're not needed as much. Like I think there will still be like tons and tons for them to do. All right, so now I'm still downloading these. Okay, what is this? Okay, I'm downloading the new estimates, which hopefully will download soon. I think I'm gonna need to eventually buy a desktop PC that's like really fast for these, almost just for these streams, because I'm using a pretty good computer. It's a ThinkPad X1 Carbon, very common for like bankers to use, but I don't think it's powerful enough for these streams. Oh yeah, I saw some questions about MBA. So graduation was good, went by really quickly, but great to just spend it with family and see my friends for like, I'll see them again soon, but kind of like for some of them, like the last time ish. Okay. Let's go to this one. We're gonna move it here. All right, so we have our operating income. Is it the correct number though? So 2023 is 34,748 versus here 34,748. Perfect. And then sales should be the same thing. Oh, okay. So I was talking earlier about how the estimates we use today may be a little bit stale. And yesterday I literally downloaded these estimates in advance of today, and already within the past like 12 hours, the numbers have increased. So 112 for 2024, 149 for 2025, which is a huge jump actually. 2026, 171. Yeah, huge jumps. So that's why I was mentioning earlier that we're going to be a little bit more aggressive with our figures than what estimates we have. So let's first of all link to the new sheet that I have here. And I'm going to do the same thing for EBIT. Which also increased. Okay, so quite a, I don't know. These numbers are just kind of so crazy. And I think we also have them for a few more years, which we probably won't use, but might as well have them anyway. So we're probably not going to even project out this many years. All right, anyway, so I gathered all the historicals, and now it's pretty much to get to the, now we're getting to the meat of really this model, which is building out the actual DCF. So we're going to project out our, let me just actually copy from our NVIDIA DCF here so that I save some time. And again, you can do this too. It's a shortcut, but you have access to my my old NVIDIA DCF. If you go to my previous video, actually, after this video, I will add my old NVIDIA DCF video to the, I'll add it to the description so that you can easily access it. But basically what I'm going to do here is I'm going to copy and then go to my current model and just copy the formatting by pressing Alt-EST and then Alt-ESV for the values. And then I'm going to delete everything in here. These are old figures. I see. I helped someone get a 19 out of 20 for my corporate finance final. Nice. Always good to hear. All right. So we're in, okay, let me adjust these years because these are formatted incorrectly. But we're in 2024. And we're all, it's crazy. We're like halfway into the year already. So we have to think about how many years we want to actually project. Usually you do a 5-year DCF. And so, but basically that would mean kind of projecting out 4.5 years because we're halfway into 2024. So I think last time we were like very close to the year end. So that's why we decided to do 6 years, quote unquote, but this time we'll just do like a very standard 5-year DCF. I think it'll also be good to do 5 years instead of more because we have a very like large company, and usually the larger the company you can just, you don't have to project as many years out. So let's actually also get rid of like these figures here. We won't need them, and they're also wrong anyway. Like you can tell these numbers are wrong because it goes from, you know, normally you see growth rates kind of decline, but you see it just increases automatically in 2027. And why would that happen, right? It's just because brokers are actually dropping off. Why would it go to -2% and increase to 14%? That's just kind of nonsense. So we're going to have to use our own judgment. So now let's kind of build out the rest of this DCF. I guess not rest of, let's actually build the DCF. So we're going to link to our revenue here. Actually double check that I'm referring to the right numbers here too. Okay. So revenue, easy. Revenue growth. Easy. EBIT. Go up here. Margins. All right. So let's start thinking now about the most, I guess, challenging part, which is figuring out what is our what percentages should we, or what growth rates and margins, excuse me, should we be using for our estimates as we project out the next 5 years. So normally, what we've done in the past is kind of just like believe that the street case is going to be pretty accurate, but as I kind of showed throughout this stream, the revenue and EBIT margins may be okay actually, but like the percentage wise, but in terms of the revenue figures, I actually think estimates are going to go higher, and I think these numbers, at least for the first few years, are going to be a little bit lower than what they will be in just a matter of a few days. So we're not going to just use what's here. We're actually going to, first of all, for 2024, I think previously, yesterday when I downloaded it, it was at about like 108 billion. Now it's, just after like 12 hours, it's 112 billion. So that's a 4 billion increase. And there's a large, I guess, since earnings came out, analysts may be expecting to be surprised again. So they may actually have already increased their estimates by quite a bit, but also at the same time, they typically tend to be a little bit on the conservative side. So if I had to guess, I would imagine that maybe NVIDIA ends up, optimistically in 2024 getting to somewhere around like 120 billion. And then more so if it's 125 billion is maybe where I'd put out like a super optimistic level. And then on a more like base case situation, I would imagine it's closer to something like 118 billion, 115, 18. And then on a conservative case, probably like exactly what we have here. So actually what I think makes sense is having our conservative case be the figure that we have here of like 94%. So that's kind of like based on the estimates that are kind of gathered today, what we think that our scenario would be. Normally we have this on our street case, but I think we need to be a little bit more on the optimistic side. So for 2024 revenue, 2024, in our optimistic case, let's see what it looks like when we have a 5% increase and then a 10% increase. I see a question if this will be uploaded. These videos are always uploaded, so don't worry about that. So what I'm going to do here is increase by 5%. So 105% essentially. And then for our optimistic case, increase it by 110%. So let's see what that number actually turns out to. So let's go to our switches. So equals offset, cell you're in, then you go to your switch. It's F4, 0. And then our revenue figure is our previous year times 1 plus your growth rate. Excuse me. So I think that's roughly where we would imagine our street case to be. So 98%. So let's see what our optimistic case brings us to. Optimistic case brings us to 117, but I actually want a little bit more. I think honestly, given how crazy it's been for NVIDIA and how things just keep growing more and more, I think we actually do want to build in more optimism for this company, just to have like a really wide range, right? So 2024, 120 billion. If we go to, maybe it's a little bit too high. Actually, I mean, it went up from 108 to 112 today, 12 hours estimates, 103% to 118 billion. I feel like that's actually possible, but maybe if we change it 7.5%. Okay, let's make it, I guess, in between. Like 0, 7.5, 15%, basically double. This optimistic case is basically like very, very optimistic. All right, so I think I'm okay with that. I do expect this number to go up, and I do think that while 101% growth is kind of crazy, very, very doable for this company. Next, what do we have here? So you can see that we were expecting about like 33% growth, 14, 20, -2, but these numbers really unreliable because they're not updated / like broker drop off. So I think what we want to do here, like I think these figures are just like all kind of unrealistic. I don't think we really want to use them too much. I think what makes sense is kind of growing this down by a percentage each year instead of kind of linearly trying to go down to a figure, which we have done in the past. Let's actually, for our, let's call it 25 to 28. Grow. Let me just see what these numbers look like. But I think what could be interesting is growing going down basically the revenue figures or revenue growth rates by 10% each year. But I actually think it's going to have to be higher than 10%. But let's just see what this leads to. Oops. Yeah, I think this is definitely probably too high. But it implies a 61% growth rate in the future, I think. Maybe negative 25%. Okay. I feel like, I think, all right, let me just build this out first. And I think I do like this a little bit more than linearly growing things down. Okay, so let's call this negative 25%. Let's call this negative 20%. Okay, so I may adjust the numbers here, but basically, you know, and if you have been watching like old other models that I built in the past, typically what I would do is start with a percentage and then choose like some kind of ending year that makes sense, or ending percentage that makes sense. Let's call it like 20% and linearly grow it down. But I think given that we're at such a high growth rate right now, I think what makes more sense is to like decrease it percentage wise over time. And, you know, these growth rates are crazy, and so are these. But, you know, this is just a crazy company, really. And I think we want to get close to what analysts kind of feel like. We kind of want to have like this really large range in order to basically see what we need to believe to invest in NVIDIA at these, what we need to believe in order to invest in NVIDIA. So I actually think what I want to do here for this year is basically decrease each year by a third. So negative 33%. And then for, let's see, for our base case, decrease by 25%. Like I think it's still not that much. Maybe this is okay, actually. All right. I like to be a little bit conservative. So I'm going to call it negative 35%, negative 30%, and negative 25%. So for each of these years, the growth rate is decreasing by, you know, a 35% for each of these years in our conservative case, 30% for our street case, and then optimistic case, 25%. So our optimistic case is starting from a higher number, also decreasing by a lower number. So it's very, very optimistic. I'm very intrigued actually to see what kind of implied stock price we get. This basically from our street case implies that the company's revenue will grow to like 495 billion. Okay, I need to sense check this actually, see if this is even like possible. I think this might be like way too high. I want to check what Apple's revenue is. I think these numbers are like too crazy actually. Apple, I believe, has like the highest revenue. They're at 90 for 2024 or in one quarter. So they're at like 300 something billion in revenue. Their quarterly is 120. So their annual is 380 billion. So yeah, I mean, I guess it's possible, but then it's like also if you look at some of the street estimates, which is where we should roughly be trending towards, I think these estimates are like too crazy actually. So maybe this isn't the best way to do it, or maybe I need to decrease this to like 45%. That means that would imply that the company is growing at 9% by 2028. Which, you know, the company cannot sustain crazy growth forever. As you can see here, you know, I think maybe we're going too crazy right now by thinking that the company can sustain this type of growth. But I think even the last DCF, I was like, I don't know if the company can reach its optimistic scenario. And let's look at what we had. So man. In 2024, we, based on the numbers we had at the past and what Wall Street analysts were estimating. They were estimating 51% growth in 2024, right? And that actually turned out to be closer to like 90% or 100%. So but, you know, with that said, yeah, I don't think that the company can necessarily keep up this like crazy growth forever. No company can. And there may be like new competition and stuff like that. So actually, I like where this number is trending towards. So like this negative 50%, maybe yeah, 6%. You know, there are times, believe it or not, when NVIDIA only grew by 4%, negative 5%. You know, it's different now, but there will be increased competition in the future. You just never know what will happen. So I think this is better. 47, roughly 240 billion. I think this is doable. And then for our base case, let's try calling it negative 45%. See where that leads to. 300 billion. And then negative 40% for our super optimistic scenario. So our optimistic scenario imagines that NVIDIA will get to 387 billion. Also pretty crazy. Maybe too crazy. Okay, I'm gonna, yeah, okay. I know, you know, who knows, maybe 6 months from now, these numbers will look low, but I think they're just too high right now. So 280, okay, this looks more reasonable. 285 billion in 5 years. So that would mean 108% to 54%. Okay, maybe that's a little bit too low. But as a, you know, as your base gets larger, it's also harder to maintain like a high growth rate. So maybe we make this around 10% growth in 5 years. And then %. Seems awfully low though. I mean, I guess there's no reason why company can't just keep growing. Okay, so revenue in our conservative case kind of gets to where the street is today. So I feel like that's good. Street case gets us to considerably higher. And then our optimistic case, very high, 330 billion in third year. So I feel like this is roughly makes sense to me. Okay. Yeah, I think the street case, while it is, you know, significantly higher than some of these figures that we have here, again, in case you're just joining now or you're just tuning to this part, street analysts have not updated their estimates. And so these numbers are likely to increase. I think it's very, very possible that NVIDIA goes actually past 116 billion. And then in these next few years, like maintains a pretty high growth rate. 50% is still like an amazing growth rate for a company this size. 25% once it's at that rate, once it's at that size is also great. I mean, Apple, while at $300 billion in revenue, is growing at like a few percentage points. So these numbers are also still very, very high actually. But possible with like the whole AI boom and everything. So, okay, revenue, feel good about. I probably would stick personally to the street case figure. This optimistic scenario is like, you know, we'll see like what happens with that. Okay, so now EBIT. I think EBIT is something actually that the margins we can actually rely a little bit more on our estimates here. For our, let's see, for our percentage of sales, 66%. They have it like growing down for a few years, 65%. I think this is like pretty weird. Normally you would expect margins to always increase over time. So I don't know if something that I just think these numbers are not very reliable. So what I want to do for our street case is just use our figure here. So let's see. Okay, street case, I'm going to use our figure here, and I actually want to hold it flat. I don't think increasing it by like 66% is already crazy margins, and it's like you're not sure that the company will even be able to maintain these margins over time, even though margins generally should be pretty steady for companies or increasing. Conservative case, let's call it, sorry, the year of 2024 to 2024. Ugh. I see a great question. Do bankers generally refer to street case in their model? They actually do. So this is what I used to do at JP Morgan is we would use our management projections from the company that they would send us their internal and 5-year model. And then we would build out a management DCF based on management expectations. And then we would build out a street-based DCF based off what the street thinks, and then compare those two. And then put all of that in a football field in addition to like trading comps, transaction comps, etc. And so what we're doing now is pretty much what I used to be doing at JP Morgan. Now, I will say that like we probably, when I was building models at JPM, I would spend like, 80, 100 hours a week working on these things. And what I'm showing you is a very condensed version. Like I would probably never just as simply just like choose numbers of like, oh, 50, negative 55%, negative 50, negative 45. I would show these to my associates. We might look at research reports to look at like general trends and trying to find percentages for like the overall industry and kind of trying to use that to back future estimates. Or we would double check the estimates to make sure that they're like super, super accurate, etc. But for this, we're kind of just using a more like high level approach. So that is like kind of a difference here. Anyhow, so 2024. Our EBIT, what should we do here? So in our base case, we're keeping it at 66%, which I think is okay. For our conservative case, sometimes margins can go down over time. If you're like spending more on operating expenses, on purchasing, on salaries, etc., etc. So let's see, 2024. Let's just say, so most likely in 2024 to 25, I think things will be pretty different than potentially 2026 to 2028. So in 2024 to 25, like I don't imagine, that's the next 1 year and a half. I don't imagine that the margins will decrease that much. So let's call it like a negative 5%. And then an optimistic scenario, let's call it an increase of 5%. Maybe negative 2.5% actually. An increase of 2.5%. And then an optimistic scenario, we would grow it by 5% or decrease it by 5%. So let's see how these numbers shape out. So I'm going to do, for the first 2 years, a decrease of 2.5%. Basically, what we are assuming here is that for our first 2 years, our estimates are a little bit lower than what the street thinks. And then over time in our conservative case, that it's kind of decreases over time. It's around 62%, which is still crazy high. So I think it's good to actually have this kind of case. So yeah, and then yeah, this model is actually a little funky because normally I would grow things up to a certain percentage. Okay, I don't know if I like this. Yeah, I don't really like this. So I think what we'll do actually instead is I like where we are decreasing by a bit, increasing by a bit, 2.5% for this first year in 2024. And then I think we should grow it up because that's kind of the more typical trend that you see with margins. Like if you look at the margins for NVIDIA over time, it's went from 16% all the way up to 60%, 66%, right? I think what we want to do in our, and also if you look at our estimates here, like street estimates believe that things will be around 65%, let's call it. So I think for our conservative case, we would just grow it up to 66%. So why do we do that? Let's and then for our optimistic scenario, which I don't think I'll use, let's grow it up to 68%. That's what I meant. Okay, so here we're imagining that EBITDA grows to, or EBIT grows to 66%, which is where it's currently at. Basically assumes that it'll maintain that. So this is where we're gonna actually grow linearly. So it'll be that minus that divided by the number of years we're in. And this is still pretty optimistic, actually. Like imagining that a company will maintain 65% margins. Like if you look at the company in the past, it's around like 40% plus. But I guess what's happening is that the company is able to price so high and people are just, customers are just willing to pay anything. And previously, we assumed like around 58% margins, 52 for conservative, 61. So things have just already increased so much for this company. I feel like these margins actually, it doesn't really build in a true conservative case. I actually think what would make more sense is if we, like sometimes, like when you can never project what is going to actually happen over the next 5 years, right? But I think by having this range, it basically implies that it'll always be like, sometimes it'll be lower, maybe sometimes it'll be higher, but it'll almost always hover around the 60%, 6% range, which I think, or 65% range, which I think is too high. I think I want to grow this down actually to 60%. And this assumes that, you know, let's say, for example, competition gets really, really fierce, and then some company like creates a better chip. And so like NVIDIA has to lower prices or something, then that will really decrease their margins. And I think we want to have like that kind of scenario in here. So I think for basically our conservative case, we have it go down to 60%, while in our optimistic case, we can grow it up to 68%. I don't want to get any higher than that, because that'll just be too much. All right, so here are our margins. Yeah, I see a comment like margins will not stay that high, but estimates are actually keeping it this high. So since this is a street-based estimate, I do want to kind of keep it close to what we have with the street. What I'll probably end up doing is actually use our conservative case for when I talk about the actual pricing and stuff. So anyway, now I feel like generally okay with what we came up with here. Okay, so now we have built our switch, and then what we want to do is multiply. All right, cool. So now we have our EBIT. Now we have to figure out our taxes, which I actually didn't get earlier. So need to add that in here. All right, so taxes, then let's just call it tax rate. All right, taxes, income taxes here. Then our tax rate was income tax divided by our pre-tax income. NVIDIA basically pays no taxes. Yeah, what did we do last time? So these are our tax rates. Income tax over grew to 4%, 5%. Oh, we grew it to a certain, because it was just paying so little in taxes. Yeah, I don't know how this company's doing this. It's crazy to me how profitable the company has been and how little it's been paying in taxes. It's just like financially engineering at like the very peak of financial engineering is what's happening here. Okay. So let's just go to how the numbers shape out first. So percentage of EBIT instead of our tax rate. Okay, so actually we should be using our tax rate. EBIT times 1 minus your tax rate. Yeah, let's use tax rate. I think what we did last time was we thought, okay, let's imagine. Oh, actually, no. Okay, what I did last time may not even be relevant, but I think we just use an average, yeah, of the past like 2, 4, 6, 8 quarters or so. We got to around 4%, and then we grew it up over time. So we started with around like 4%, and then we grew it to around 10%. What's the average here? Okay, honestly, I think we can do, well, if it's 12% here, maybe we can actually take a look and see what tax rate they used or they paid in this last quarter. So let me drag this here. Oops. So we're going to bamsec.com. Go to NVIDIA. So they just announced first quarter. Then if we scroll down, try to find their taxes and their income statement. So income before income tax expense. So if this is basically 2398. So let's call it 2398 divided by 17,279, which is their. Okay, they paid 14%, which is a lot more reasonable for a company this size. So they paid 14%. Seems like there's an upward trend for the taxes the company will be paying, which makes sense. They should be paying more taxes. Don't know what they did in the past, but let's see what. So this past quarter, they paid 14%. In the quarter beforehand, they paid 11%, 8%. So the company is going to continually just pay more and more in taxes, it seems. So that will meaningfully decrease our valuation. I think I am actually okay with this 14%, given that like the trend seems to be that it's increasing. So 14%, I'm going to add a note here that this is based on Q1 2024 earnings. So it's 14%, and then Where is NVIDIA domiciled? I don't think NVIDIA will actually ever pay the full tax rate because companies are so good at not doing that. But it's based in Santa Clara, California. So probably, pays US taxes plus also like international taxes, I'm sure, which is helping bring things down. So let's see. If a company is making this much in profit, is paying 14%. I feel like that's pretty conservative enough to keep this flat all throughout the 5 years. I think this is pretty fair, and you can adjust this, but I can't imagine that, like in all of its history, actually it has paid 16-17% at some points. Low here. I think this will take into account times where, for whatever reason, they're able to really lower the amount of taxes a lot, while also sometimes increasing to like 16-17%. So I'm going to keep it flat at 14%. So taxes, get our EBIT times our percentage here. Okay. So EBIT is earnings before interest after taxes. So basically our EBIT minus our taxes. The rest of this is going to be pretty easy because the numbers kind of just D&A and CapEx just kind of cancels each other out. Oops. So D&A, I'm going to press F4 twice to anchor our row. Okay, so our D&A I'm just going to take an average. The last 3 years. Do the same thing for our CapEx. Same thing for our net working capital. Although 9% is a little high. Okay, so make this just equal to that. We have our D&A, we have our CapEx, which is lower than our D&A. It's kind of weird, but negligible. And then we have our change in net working capital. I'm going to double check what we did last time. I don't know why a number is missing here, but 9% just seems a little bit high, because in the past hasn't always been higher than that. I think 5% ish is where we want to be, or maybe take the average the last 5 years. I think this is closer to where we would actually end up. Okay. So maybe to just keep things consistent for our cash flow figures, we'll just do that for everything. which also makes sense because your CapEx should always be a little bit higher than your D&A. All right. So now we can calculate our unlevered free cash flow, get our EBIT plus D&A minus CapEx minus change in net working capital. Then we're going to actually need to figure out our WACC. Oops. Just going to retitle some of these tabs. We're going to call this WACC. All right. WACC. Let's see. Also, it's 2:37. I have a hard stop at 3, so I'm trying to wrap this up in the next 20 minutes or so. I'm going to go into our old NVIDIA model, copy paste our WACC sheet. All right, what's crazy is that just about like, I don't know, 8 months ago, I forget when exactly I did it. Actually, I have the date here. September of last year, NVIDIA was at $1 billion in market cap, which was already high. Now it's around like 2 billion. Let's grab that figure. While this is loading, since it's super laggy, I see some questions in here. Can you talk a little bit about your coming course? Would it be a self-study format? So the banking course will be, and what I am really trying to do to make it super, super helpful is as you're learning the concepts, you'll also be building like high level, simpler models than we're building here. But I think the best way from like teaching a lot of students for getting into banking, the best way to learn is by actually, you know, creating some comps yourself and then creating like a high level DCF or LBO, accretion dilution model. So as I'm teaching the concepts, I'll be also like teaching, you'll also be going through Excel. I've been working on it with friends who have worked or will be working at Evercore, or have worked actually, Evercore, JPM M&A, and then Goldman. So I think it'll be a great course. Probably will launch late fall, early winter is what I'm aiming for. And I see another question. Shouldn't you multiply EBT by the tax rate instead of EBIT times tax rate? So for your unlevered free cash flow, the formula is actually EBIT times 1 minus your tax rate. So it's not EBT times 1 minus tax rate. That would be more for your levered free cash flow. So, okay. So anyway, let's change this market cap. I'm going to just hard code it here. 2373.8 billion. 2373.8. Everything here will be in millions. So, wait, 2, 3. Oh yeah, it's 2 trillion in market cap. Crazy. Okay. So percentage of equity. This is This is a formula. Okay. Risk. I'm just gonna have to delete all of this. Risk-free rate. Let's go to Chrome. 10-year treasury yield. So risk-free rate 4.475%. Forgot to add an 8 here. This market cap also is probably not. Oh yeah, fully diluted is what's a little closer. So 24089. Beta, dang, went up quite a bit, 2.2. Guess that's true though, it's a lot more volatile. Market risk premium. Let's grab from Damodaran. Okay, implied equity risk premium, 4.15%. On May 1st, 2024, okay. 4.15%, and then debt. We're gonna have to go to the company's balance sheet. I don't like how this is formatted. It looks weird. All right, so we can see that the most recent quarter is not actually uploaded. So we're going to have to go through the filing, go to the balance sheet. Okay, so short-term debt, 1.25 billion. So debt equals 1250 plus long-term debt, 8460. So about 9 billion. Basically, this is very, very unimportant because it's a very, very small part of NVIDIA's capital structure, and we're gonna have to find the interest rate. Usually you can find on the cover of the 10. Okay, maybe not. So as of fiscal year, we have 9.7 billion carry notes at face value. It's okay. So the effective interest rate based on all this, anywhere from 0 to 3.73%. I really don't want to calculate all this. So let's see. Okay. So you need to calculate the weighted average and everything. So I'm going to call it 2% or 2.5%. Just roughly eyeball it. And it's 0.5% of 0.4% of the capital structure is really nothing. And then tax rate. So yeah, it's a shortcut. Definitely what I wouldn't do on the job, but whatever. All right, so now we have our WACC, 13.56%. Seems quite high, actually. So let's figure out. It's probably just really high because the beta is so high. So let's see what it was in our last DCF. Last DCF, it was 11.7%. Our beta was at 1.65. And yeah, so I don't like this. Good to still calculate though. And probably won't use it, but at least we have a baseline. All right. Let's see. So what WACC should we use? I wish I had equity research reports, then I would know. So let's see. Cost of equity is 13.6%. So here's how I'm thinking about it. Generally speaking, for a company that is relatively mature-ish, let's call it like Apple, let's call it super mature actually, then their risk-free rate their WACC should be somewhere around 8%. Maybe, 8%, even less a lot of times. And then for a more kind of in the middle company, it's around like 12% usually. And then if it's a little bit more on like the startup side or growth side, 12%. If it's like a startup, then it's like 14, 15%. If it's like a super tiny company, then it's probably like up to 20%. But NVIDIA is, one of the largest companies in the world. And so I don't think it really makes sense to have like a 13.6% WACC. I think for our base case, probably having it somewhere be around like 11.5% would even still be like kind of high. I see a comment that says average beta industry should be 1.5, will converge in the long run. Like this changes a lot over time, right? I mean that beta makes it 10.66%. So I'm going to keep what I have in here, but I think what makes sense is having something around like a 10.5% WACC here for our base case. Optimistic case, let's call it 10%. And then our conservative case, something like 11%. So that's what I'll use here. And we'll do same thing for terminal growth rate, but this one is just usually 2.5% growth rate of the US economy. Optimistic 3%, pretty much would never use, and then conservative case 2%. All right, almost there. Actually, I have 12 minutes. Let me check what time this person's coming to my place. Okay, actually I have until 3:30. All right, so let's, actually I forgot to name these. So I'm gonna name these cells here. I'm gonna name this one WACC. I'm gonna name this one TGR. But before we calculate our present value, we also need to calculate something called our discount period. So the reason for this and reasoning behind this is that when you project out your figures and you're building a DCF, you always want to only use future free cash flows. You don't want to use any that have already passed. And we're in we're at May 23rd, 2024. So May 23rd, 2024. So that means 5 months, almost 6 months actually, of this year's cash flow already has passed. So we don't want to use any of that. So in order to calculate that, what we want to do here is calculate how much of the year we do have left. So what I'm going to do is get our start date and then our end date. This is going to calculate basically what portion of the year that we have left. Okay, this is lagging, so I'm going to use my mouse, which I never should do, but whatever. All right, so you can see here we have 0.61 years left. And what mid-year convention is it's a simplifying assumption that bankers use when they're figuring out their discount periods of saying, okay, you get your cash flow every single day. And what would be the most ideal is if you're discounting to each day or even hour or minute, and then calculating all your individual tiny free cash flows and then discounting based on like the actual time that you get your free cash flow. But that's like impossible. So what bankers say is just, okay, let's make a simplifying assumption that you get all of your cash in the middle of the year instead of at the very end. So what this just basically means is that, all right, we have around 60% of the year left. Let's say that we get our cash flow for 2024 in the middle of what's left in this year. So let's get it basically in September or so. And then for our future years, let's say we get it in the middle of each year. So we're basically calling it in June 30th of each year. So in order to get that figure, what we need to do is get, so what is it? Our period is, get this number, which is the end of 2024, right? We have 0.6 years left, and then we add 0.5. That gets us to, we have a year and 1.1 years left until June 30th, basically, June 30th, 2025. And then from this point on, we add 1, because this gets us then to June 30th, 2026, and 2027, 2028. So now we can calculate our present value of free cash flow. So we get our unlevered free cash flow divided by 1 plus our WACC to the power of our discount period. Oh, dang it. And then we can do that for our remaining years. Terminal value. So in the past, previous models, I've been doing somewhat with exit multiple method and stuff, but I think with NVIDIA, given that like the multiples are not going to be very reliable, I'm going to just use terminal value. Perpetuity growth method. So for that, what you do is you get our last year's free cash flow times 1 plus your terminal growth rate, and then you divide all of this by WACC minus your terminal growth rate. It's just a formula that you need to memorize. And then present value is getting our terminal value plus divided by 1 plus your WACC to the last period you're in. That is our present value of terminal value. So then our enterprise value is the sum of your present value of your free cash flow and your terminal value. And then cash, we need to get that number from the latest filing. Oh, I see a comment. First time seeing you on the live. Would like to take the opportunity to thank you. Your videos helped me get my first IB internship. Nice. Good luck with your PE internship interview. All right, let's find this cash figure in the balance sheet. So, damn, there's so much. They got a lot of cash. 31.438 billion compared to debt. I mean, 31.438. They're just a cash generating machine, probably. 31.438 cash, and then debt we calculated already, which is 9 billion. So the company could easily pay off all their debt, but they're probably deciding to invest in the company instead. So equity value, enterprise value plus cash minus your debt. Let's get our diluted shares, which is, let's see, fully diluted shares, 2,537. And remember, if you're watching this after June 7th, the company is going to have a 10-for-1 stock split. So later, they're actually going to have like 25,370-ish shares. So the stock price we're going to get to is actually going to be different. So our implied stock price here is 684.82. Surprisingly low, actually. But let's adjust to what I think would make sense here. So revenue in terms of growth. So actually, let's get here implied price per share, current share price, and then implied premium, upside, downside. So currently our implied price per share $684. Current share price obviously a lot higher. 1,042.31. So implied is this. Okay. Well, let's try to, let's look at what I would personally use. So growth rate wise, we're looking at our street case. I think street to optimistic is where I would land. And then for our EBIT, I would probably use our conservative to street. So what I would say here is let's basically calculate the low end of what I kind of would believe, and then the high end. So WACC wise, I would actually argue that we should use a lower WACC. Terminal growth rate we can keep around keep it at terminal growth rate of 2.5%. Revenue on the low side, I would use street, and then on the low side, I would use our EBIT of conservative case. So on low end, basically, this gets us to 672.75. And then for our revenue, on the high end, optimistic, and then I'd probably go no higher than our normal case for our street case for our EBIT. That gets us to 898.48. So let's try one more thing of like making things all optimistic. Terminal growth rate I'm going to keep at 2.5%, but that in our most optimistic scenario, that gets us to 929.34. Now, why are we lower than what is than like what the current stock price is at? I think mainly, let's see. Probably we'll have to do mostly with two things. It's either our revenue growth rate and then it's our tax rate. So let's see, let me think. Like I'm thinking, have we been too conservative anywhere? I mean, growing at 100% to a $120 billion company, then maybe in an optimistic case, 60% the following year, and then 33%, 18%, 10%. I feel like is pretty reasonable, achievable for the company, but will it get much, much higher than that? Maybe. I don't know, but will be, I don't know. Maybe is this too conservative? Like you could argue that, and I think definitely play around with this model to see if you need to change these figures, and I'll probably end up doing an NVIDIA DCF like every 6 months or so, as long as the stock keeps running hot, because there's so much interest in it, and I feel like it's good to update the model every 6 months or so. So it would be very interesting. Like let's check in basically 6 months from now to see where the stock's at. But for me, at least as of now, I personally view like the max to be kind of around this range where it's at 898.48, which still, when we look at our previous model, oh, interesting. For our previous model, I actually used a 9% WACC. And yeah, I could argue that the WACC should be lower. So maybe that would change things a lot. But even like 6 months ago, I think our optimistic scenario was at 438, and already it's doubled to 898. I mean, maybe let's see if we change this to a 9% WACC, that gets us roughly to where we are at today. So, I mean, let's see what has changed in our WACC. WACC is like a super, super important driver. So, I mean, basically, I think last time what I did is I calculated our WACC, deemed it way too high, and just used like a lower one, because I do think that it's fair to use a lower WACC. Okay, so let me readjust some of these. So I'm going to say 9.5%. I mean, you could honestly argue that the WACC should be even lower than 9%. So let's see. This might make a little more sense. So I'm going to use a WACC of 9%. You know, for the largest companies in the world, as I mentioned, WACC should normally be somewhere around 7%. So I think even 9%, you could argue, could be even lower. So let's say an optimistic case scenario make it actually 8%. And then our base case, we make it 8.5%. Essentially, I'm kind of juicing up the numbers here, to be honest. But I do feel like also this is what makes sense. So I'm going to use actually our 8.5% WACC. If we, let's see, revenue-wise, use so I'm going to calculate our low end again. So this is what I deem to be kind of like our low end. Right, let's actually use conservative. Okay. Ooh, what the heck happened here? Okay, yeah. Our low end, I would imagine, would be around 774.13. Our high end, I would use our optimistic case here, street case here, and base case here. I mean, that's what I should be saying. So then on the high end, 1124.69. So which implies 8% increase. So like basically, even with all of this optimism, so let's say we even use like our optimistic, most optimistic scenario, so super optimistic. Let's call it optimistic. Then 1270.2. So which implies 22% upside. So then basically, as I stated near the beginning of this stream, in order for NVIDIA to have any upside, it just needs to keep really, really, really crushing it. And based on this model that we built today, which is based on the information we have today, there's even a very optimistic scenario about a 22% upside, and you could argue that it's easier to find like more upside in other companies. But anyway, that's what we really get to here. I'd say the range for me is kind of more towards 780 to 1,100. And so I don't see like so much more growth upside for NVIDIA, but the stock does keep surprising us, and the AI boom is going to only continue going crazier and crazier. So unless someone supplants NVIDIA, then the company may just continue seeing this kind of crazy growth. But it'll be very interesting to see where we are in 6 months or so, basically, when I'll do this again. So hopefully this was interesting / helpful exercise for a lot of you guys. I'm gonna leave this when you guys download it to what I think is like more base case, which is around here, basically using base case for everything. So yeah, if you want to download this, be sure I'll be adding a link. I'll also be on LinkedIn posting like the trading comps for this as well and stuff like that, so you can check out my LinkedIn. Just look up Ben Chan. And then I think, oh yeah, the other stuff, if you're interested in learning about hedge funds and kind of what you do and the fundamentals for that, then check out Wall Street Prep and their buy-side investment certificate program, which they're offering with Wall Street Prep and Wharton. I'll leave a link to that in my description as well. And you can download this soon. If you want to, if you have any questions, let me know in the chats, and I'll answer a few before I sign off here. But I built an NVIDIA DCF valuation models before. Is there an incentive to build one? It's really just, as you're mentioning, for educational purposes / when I build a model 6 months ago, I'm using street estimates that were from 6 months ago. And so now they're completely stale. And so these numbers here, a month from now, probably also will be a little bit stale too. So by creating these new models each time, then you're basically, when you download this model, using like the freshest new information. I think you missed a calculation for unlevered free cash flow. Did I? Let's take a look. That might explain things, but I don't think I did that. So, all right, so present value free cash flow calculated here. Terminal value I have here and here. Enterprise value, I added a present value of free cash flow plus terminal value. So it looks right to me. Let me know if, I guess, you're seeing something different. Oh, wait a minute. Nope, this is also right. Okay, so yeah, looks, wait, why are these numbers exactly the same though? That's so weird. That cannot be coincidence. So try calculating this again. Equals plus DNA minus CapEx minus change in net sales. Oh, interesting. Thank you. That's so weird. So I don't know why I wasn't calculating earlier, but wow, that does change our numbers slightly, but probably not by like crazy amount. All right, so let's calculate this again. Oh, I was subtracting the percentage. Okay, thanks so much. Oof. Okay, great catch. So let's calculate this one more time. So revenue, okay, let's calculate low end, which I think is revenue, conservative case here, and then maybe our conservative case with our WACC. That gets us to implied share of, it's gonna lower things a little bit basically. High end of what I personally believe is using an optimistic case here, base case here. Yeah, I'm okay with optimistic. Actually, base is 8.5%. Let's use 8.5%. So doesn't change it by much, but does make an impact. Optimistic case here. Okay, so yeah, it doesn't change things by much, but does make a difference. So thank you for catching that. All right, so I think that's pretty much it. Thank you guys for tuning in as always, and I'll be trying to do these streams once a month. So feel free to basically come back to my channel, go to the live section, and you'll see these streams at least once a month. So that wraps it up. Thanks, guys, and see you next time. Bye.